In this presentation, we're going to enter an adjusting entry related to notes payable or loans payable to break out the short-term and long-term portion of them. Here we go with Xero. Here we are in our Get Great Guitars dashboard. We're going to start off by opening up our balance sheet. So let's go to the accounting dropdown. We're going to open up the good old balance sheet. Once that opens up, we will mouse over the tab up top and right-click on that tab. Duplicate that tab. We're going to be entering the adjusting entries as of the end of February, so that's going to be our cutoff date. We didn't enter adjusting entries as of the end of January because we don't want to basically do that section twice. So we're saying, hey, there's going to be a cutoff date. We need to have the financial statements on an accrual basis as of the end of February here. That's going to be our cutoff date. We're concerned now with the long-term or the liability section, and that being the notes payable. So if we go down here into the liability section, you'll note we have these two notes payable now. Now we put them into the notes payable, into the long-term notes payable, so they're kind of grouped together. We also put the numbers in here for them. And we want to list each account out so that we could then go into our amortization table and be able to enter that information in accordance with the amortization table per loan. However, we may have a short-term or long-term portion related to these notes. We're going to deal with these two notes a little bit differently. Now, this first note, we have monthly payments on it. That's going to be kind of like a standard type of note that we're probably more used to, like a mortgage where we have to pay monthly, have an interest and principal portion, or like a financing something as a car or something like that. And then this other one, remember, we can have a lot of different terms on a note. So the second one, we're going to say it's a note that's going to be due at the end of the period. So we have a loan that we have, and we're going to have to pay it back plus the interest at the end of the period. Now, if you're paying it off periodically, such as the first note, you'll have a short-term and long-term portion possibly of the note if it's a note that's going to be extending past a year. We'll deal with that next time. This time, we're going to deal with a little bit easier of a scenario, in which case we're going to say this entire thing is due within a year. Therefore, whatever balance is on here, we need to basically transfer it from the long-term portion over to the short-term portion. So again, strategy here is I'm going to put everything under the long-term loan portion down here, track it one account at a time, and then do periodic adjusting entries to break out the current and long-term portion as needed. And then once I've done those adjusting entries, I will reverse them to bring it back to this setup because this setup looks good logistically. That's typically the case with a lot of the adjusting entries. We might have a difference in terms of what works well from a logistical standpoint for data input and accounting, and what we need to do to make the financials right periodically at the end of a cutoff date, like the end of the month or year. Okay, so just to get an idea of this in terms of our loans, the two types of loans we have, the one loan we have over here is one we're paying off monthly. So that one we're paying off monthly, we're going to have a short-term and long-term portion given the payments that are going to be paid off during the month. Anything that's going to be paid off that was a principal balance in the year is going to be short-term. This second loan, the one we're dealing with now, is we're going to say it's going to be due interest and principal at the end of 6 months. And that's less than a year, the entire thing. Therefore, the current balance, which is on the books, which we're currently saying is the $50,000, I'm just going to move the $50,000 from short-term to long-term. So if I go back over here, what we imagine happening is, started choking there, had to take a break here for a second. Back though. So what we're going to imagine doing is the $50,000 here going down to zero, and then the other side going into the current liabilities section. The adjusting entries will typically be done with journal entries, so that's what we're going to use. We're going to go back to the first tab. We're going to select the accounting dropdown. I'm going to go down to the reports. We're looking for the journal entries as we do this. Then we're going to go down to the accounting. We're looking for the journal. We're looking for that journal report because that's where the journal entry kind of section is. And then we want to add a new journal. So we're going to go to this little item, this button, this hyperlink that says add a new journal. This is going to be and it's important to put ADJ. It's going to be an adjusting entry. We want to be able to label these as adjusting entries. We might want more. We may want more description than that, but I want to put that it is an adjusting entry for sure, so that we know the adjusting entries versus kind of the accounting entries. We're imagining the adjusting entries as like a separate department, or you could do it yourself, but imagine it as a whole separate item that you're putting into the system, right? Imagine accounting department, then adjusting department, or accounting department, and then the CPA possibly firm at the end of the month or at the end of the year. We're then going to say the date will be the cutoff date as of the end of February. So it's always it's always the end of the month. We're going to do the end of the month period because that's when we care about the financial statements. We want them on an accrual basis as close as possible as of the cutoff date when we make the financial statements, in our case, the end of February. Then we're going to say that it's going to have a decrease to the notes payable here. Now this is a credit balance account. So to decrease it, we're going to debit it. I'm looking for that notes payable with the 7642. So let's go back over here. We're looking for notes payable, or just notes payable, the 7642 one. It's going to go down with a debit of 50,000. Then we're going to credit, and the credit is going to be going to a new account, which we're going to set up here in the current liabilities. And I'm just going to call it notes payable. I'm not going to break it out between the two loans. I'm just going to put all the short-term portion into one account because it's just for financial statement presentation purposes. And then I'm going to reverse it as of the beginning of next month to get back to what's good for us logistically. So I'm first going to consider what type of account number we want. So I'm looking in the liabilities accounts, and I'm going to put it, somewhere around the current liability. So here's 2660. So let's go to 2165. Let's use 2165. Let's go back up 2165, 2165, 2165, 2165. And then this is going to be a current liability. That's the point. It's going to be a current liability as opposed to long-term liability. So here's the liabilities. We want to be on the current side of things. And then the name is let's put an S on it. Payable current. Let's put current portion. And then description, no description. I'm going to say save that. And it should pull that over. So what's this going to do? It's going to increase the notes payable current portion. It's a liability, so it's going up with a credit. It's going to decrease the notes payable that was in the long-term portion, which is going to go down. So I'm going to post this. Let's see if that happens. Let's go over to our trial balance. And then if I scroll down to the trial balance, before I hit refresh, what's going to happen? This one's going to disappear and a new account's going to pop up here in the current liabilities, hopefully. So let's go ahead and update and see if that is indeed the case. Scrolling back down, we then have the only one note payable down here, and then we have the notes payable up here in the current portion as well. Now note, you can adjust like the order of these accounts if you would like to adjust them in some different ordering up top using the edit layouts on the bottom left hand side. And if we wanted to kind of remove the account number over here, we can create another subcategory to basically remove that as well. But at this point in time, we've got the current portion broken out. In a future presentation, we'll deal with this one, which will be a step harder in that we'll have a current and long-term portion of this notes payable. So that's it for now. Let's get out of here.